Hello everyone, welcome back to All Financial Discussion channel. For this video, I want to do a comparison between CPF and S&P 500. For me, this is in fact not a fair comparison, apple to apple. For me, CPF will be like insurance, while S&P will be like investment. How can we actually compare these two different things? So for me, I will say this, stop comparing these two, CPF and S&P 500, and I'm going to explain why. A lot of us in Singapore, including myself, we always like to compare CPF versus S&P 500. This is because CPF in fact has a yield between 2.5 to 4%. So therefore, we always like to compare against investment like S&P 500. We always thought that if I don't put my money into CPF, if I put into investment like S&P 500, then we are able to achieve a higher yield. But for me, so these two items, CPF and S&P 500, they actually serve different purpose. CPF is like insurance. We don't look for returns. We want to have assurance, some form of guarantee. While when we put money into investment, definitely we look to have some form of return with higher risk, but a better return. So therefore, for me, we should not compare these two. It's not a fair apple-to-apple comparison because for CPF, they serve like insurance, while S&P 500, they serve like investment branch. If you still insist to do a comparison, let me do this honor. For example, CPF in fact is backed by Singapore government. So the key purpose is for retirement saving. While S&P 500, they are basically like stock market and basically they trade the largest 500 US company. Next, for CPF, in fact, it's a very, very low risk, almost zero. Let's say if you want to quantify number, 0.01% of risk. While for S&P 500, because the stock market going up and down, so therefore it is a very high risk. The market is in fact very volatility. Next, for CPF, you are going to anticipate a stable return, a constant DC stable return. While for S&P 500, like I mentioned earlier on, the price actually go up and down, in fact, in every hour. So therefore, we can't guarantee any form of stable return. Next, the CPF actually contribute from both the employer and also the employee. While for S&P 500, you actually invest in a voluntary way by buying a S&P 500 index or ETF. Last but not least, for CPF, it is mainly to design to preserve wealth. So therefore, you can't easily draw up the money inside your CPF. And the objective, again, I like to emphasize, is to provide some form of retirement income. So lately, we have this CPF Life, which actually guarantee a lifetime payout. While for S&P 500, again, although you can actually invest for short-term purpose, but later on, I'm going to share with you, for S&P 500, in fact, it will be good for long-term capital growth. S&P 500 investment should be long-term rather than short-term. If let's say that we take a shorter-term viewing of this S&P pricing, let's say you actually buy S&P 500 over here, and you actually sold this S&P 500 over here. So therefore, from here, you can see that, in fact, you make a loss. And technically, from this graph, you are not able to see the direction of this S&P 500 because they are up and also they are definitely also down. So in order to invest into S&P 500, we must look at the longer term, which means that you must be able to put your money into S&P 500 for a longer time. Let's say that we take a look on this 6 month. So from here you can see that in general, after this April 2026, you can see that they actually gain some momentum, up momentum. So therefore, like I mentioned earlier on, the longer term that you actually can put your money into S&P 500, this in fact will benefit you more. So again, if we are able to take a longer view on S&P 500, let's say that if you intend to put your money for more than 5 years, you can definitely see that the trend is actually going up. And the key thing is, if you are able to catch this opportunity to buy, then your return will be better. A quick disclaimer, I am not a licensed financial advice. This video is for entertainment and education purpose only and should not be considered financial advice. Please conduct your own independent research and consult a professional if needed. Never invest more than you are willing to lose. With this, let's continue the discussion. But before, I would like to urge you guys to help me by like this video. When more of you guys actually help me to like this video will have a better chances to reach out to a larger audience. So guys, help me press the like button now. For those who are new to this channel, and if you have learned something from this video, hope you can support me by subscribing to this channel and turn on your notification bell. Once again, thank you so much for strong support. Next, I like to explain the typical returns of CPF and also S&P 500. Let's come to the CPF first. So basically, this is for current rules. For example, for OA, you are able to earn 2.5% per annum. So this is actually the minimum amount from OA. As for SA, RA, and MA, you are able to earn 4% in an annual basis. So again, this will be the minimum guarantee amount by Singapore government. So in fact, for some, we are able to earn additional 1 to 2% depend on our age and also depend on, for example, the first 30K or 60K, depend on situation. Because of this in fact boosts our effective return for many CPF members. This return, okay, from the CPF, in fact, is guaranteed by Singapore government. So therefore, this is almost 0% risk. Moving to S&P 500, this is slightly different. Okay, so although you can see that the yield is quite attractive, once glance, definitely every one of us will put the money into S&P 500. 10%, okay, even if we remove away any form of inflation, we still have this 7% of yield, which is considered much more attractive as compared to the yield over here, okay, at the CPF. However, I like to emphasize this. So basically, the annual return can vary very drastically. So sometimes in the very strong year, we can have a 30% of yield. At a very bad year, okay, so basically, in fact, you will have this minus 20, which means that your capital depreciate by 20%. But for CPF, okay, there is always positive, no negative. So therefore, from here, investment into S&P 500, at the very bad year, you probably may have some form of loss. For example, at the extreme, minus 20% or even some bear market, we actually can see some, although it's just a very short time frame, we can actually see a situation that actually decline more than 40 to 50%. I think I have done enough discussion why people actually compare CPF versus S&P 500. This is because of the opportunity cost. Like I mentioned earlier on, once glance on the yield, definitely majority of us will put money into S&P 500 rather than CPF. However, there are actually two sides of the story. Okay, because some people in fact can take a higher risk. So therefore, for CPF, we actually can do some form of investment on our OA and also on our SA. In fact, we have this CPF investment scheme. Probably I will do some form of discussion how to invest your OA or SA account. While on the other side, okay, we have people that actually enjoy the CPF compounding effect. So basically, this is the effect of CPF and S&P 500. Next, why the comparison in fact can be misleading. Okay, so the S&P 500 higher expect return, okay, basically is to compensate for taking more risk. So for example, let's say that you actually invest 100K for 10 years. So for CPF, okay, so we do a very worst case calculation under OA. Okay, so basically with 2.5% of annual. So basically you will earn about 28K. So for S&P 500, let's say that it's a very steady 10%. So this is actually very optimistic calculation on the average. So your return, in fact, you can see from here is more than what you actually put, even 2 times more than what you actually put. However, keep this in mind, the 10% is not guaranteed. So if you happen to invest at the wrong time, just before a major market downturn, your portfolio could be worth substantially less than what you actually has several years ago. Coming to my last slide of today's presentation. So in fact, a better comparison, rather than we ask which is better, we probably need to ask ourselves which are the things that we actually prefer. For example, let's say for someone that actually prefer some form of certainty and also capital preservation, CPF is probably the choice. It is almost very hard to beat CPF with a guarantee yield of 2.5 to 4%. So basically, these are for group of people that emphasize on risk-free, a lot of guarantee, a lot of certainty. Next, for those who has a long-term investment horizon, like I mentioned earlier on, even though if you invest into S&P 500, this must be also some form of long investment rather than short-term. And again, this group of people, they must be able to withstand some market volatility, some form of risk, because the market go up and down. But historical for S&P 500, they in fact can offer a higher expected return as compared to CPF. Last but not least, let me do a quick conclusion. Majority of us in Singapore, in fact, we have this both, which means that we have CPF and we also invest very heavily, like for example, S&P 500. So basically, this is emphasized on the diversified global equity portfolio. So the key question is, if you want to have a guaranteed return, do majority on the CPF. If you can tolerate some form of risk, some form of better return, but uncertainty return, then you probably can go some form of investment like S&P 500. With this, I'd like to end my discussion. Please help me to like this video and subscribe to this channel. Once again, thank you so much for strong support. I hope to see you guys soon. Bye for now.